Well, good morning. Happy Friday. Megan.sisk.aller and I are back together again. I am not in my camper this week. It's coming again, though. My husband and I have decided once a month, every month, we're going to be trapped in that tin can. Mm-hmm. So we're going to do it. We're going to do it. It was a little windy when we went this last time, so I'm hoping for better weather next time. But as we come back together again, I got one thing. As Megan and I come back together again, we're constantly talking about what's changing, right? I mean, because this is an intense market that every week it seems like there's big news, but we also know that the thing that is happening is interest rates are going up, home prices are going up, affordability continues to be a strain, and that's not going away overnight or anytime soon. So all we can do today is continue to watch how much it is impacting our buyers, how much we should be having conversations about hurrying up some of those buyers to get into the market, and then walking some of our buyers out of the market. And I know I'm having those conversations too, where people are saying they simply can't do this. So with that, I'm going to start out with our quote. I'm going to hand it over to Megan. We're going to dive deep into the real estate data, then go into the economic data. But here's my quote that spoke to me this morning. Your days are better when you focus on your blessings more than your problems, right? And I could say that for all things here. When we focus on the opportunity, when we focus on the future wealth growth, when we focus on what real estate can do, jumping in when it costs us more per month, when it costs us more for a down payment, and when it costs us a higher interest rate, we have to focus on the blessings, not the problems. So with that, Megan, let's get started.
Let's get going. Things have really calmed down out there since we were talking about the monthly data back from February. And so the number of shows per property has gone way down. And so you need to start setting seller expectations as we head into the later part of spring and getting into those summer months. Our market popped really early this year. And so our market really jumped off. It was January 2nd and the buyers were ready to go. And they went out in full force for January, February, and the very beginning of March. But getting into April, things have really started to calm down. Our active inventory is way up this week. And so it's been great to see that active inventory making its way to market, but we've still faced with, if I'm going to list my home and sell it, where am I going to go? And I heard a really funny description of how the market was determined or how it was described this week. And it's kind of like a hot pocket that hasn't been heated up correctly, where it's really hot on the edges, but still kind of frozen in the middle, where you have those real hot pockets of opportunity and where the market's still going crazy, but then you have some cooler spots in the marketplace too. And so we've got a hot pocket market going right now.
You didn't think that through when you started. No, I didn't. It's also a tongue twister.
Yeah, it is. That's hard to say. So we're just going to go through all of the monthly numbers today, and we're just going to go through everything real super fast for you guys. We might end up wrapping up early today, but we've got over 600 people on this call today. So it's great thank you for joining us. We've got a great crowd that's joined us today. Looking at all prices. And again, our strategy sheet pre-COVID was that our target timeframes in the month of March, April, and the beginning of May for you to list. And so we've really started to watch our buyer pool start to wane as we get deeper into the spring months. People are calming down, buyer fatigue is setting in, people are getting knocked out of the market because of affordability, and people can afford significantly less now than they could at the very beginning of the year. And so things are really starting to pull back a little bit earlier this year. Here's our strategy sheet for 2022. And as you can see, we've got some blue cells that are creeping in, and these blue cells that are popping up really deal with our active inventory.
Even though it's so the sharing on that. Live is
there we go.
All right.
So that's going to screw up your presentation when you go.
That we'll figure it out.
Okay. So, but you can start to see some of these blue cells creeping in, and this is average daily active count, new listings, and back on markets are starting to go back up again. And so people might be having some buyer's remorse. It depends at what point does the transaction fall apart. Does it fall apart before the earnest money ever makes it to the closing or to the title company right at the very beginning for buyer's remorse? Or are we starting to see some of those loan objections that are coming through towards the end? Some more blue cells that are coming in are shows per listing and shows to contract have started to cool down a lot as well. So instead of seeing 100 showings on a property over the weekend, you might be seeing 25 or 30. And instead of getting 20 to 25 offers, maybe you're getting 5 to 10. So the market really has calmed down quite a bit. It's still multiple offer market, but it's not quite the same frenzy that we were experiencing back in February. Looking at this week's worth of data, we still stayed at our predictive month supply of inventory at 0.4 months worth of inventory. And that's the same as what it was over Easter weekend, just slightly lower once we round out those numbers. But that means that at the current rate of sales, we're going to sell out of all of the existing inventory in about 14 days. And so the market is still moving very quickly, but it's definitely not moving as quickly as we were when we had 0.2 months worth of inventory back here in January and February. So inventory loosened up a whole bunch. Our average daily active count came up to 2,600, which is more than double the inventory that we had back in January and February. So lots more choices out there for your buyers to take a look at now. That was up 21.5% from where we were 1 week ago. And year over year, we're actually up 57.9% in terms of our active inventory. So a lot more inventory out there this year than what we saw last year, which is a good thing. We need that inventory to be making its way to market. New listings week over week, the week after Easter weekend came up by 42%. So we had 1,800 new listings that made their way to market. Back on markets popped up to 202 units came back on market this week. So again, some buyers were more setting in, maybe some loan objection stuff is happening out there, but we're seeing more units that are coming back on market. Overall, that number is still historically low. Historically, before COVID, we would see about 14 to 16% of the contracts fall out of contract and come back under contract. Now we're looking at closer to about 6 to 8% of contracts falling apart, then going back to market. So it's still historically very low. Pending transaction count popped back up. So we were up 33% over where we were for Easter weekend. Again, speaking to the volume of if you should be listing over holiday weekends or not. We've got a bunch of holidays that are coming up as we go into May, and it's a very distracting time for you. Going into May, we have Mother's Day weekend, which is more of a Hallmark holiday where we end up seeing about a 10 to a 15% cut in buyer activity over that Mother's Day weekend. Then we've got all of the graduations. We've got everything from kindergarten through college graduation. We were just talking about that. Nicole's son is graduating from college in that third weekend in May. But then we also have Memorial Weekend, and Memorial Weekend is the kickoff to summer. And that also starts our slower period within the real estate market. And so getting into Memorial Day weekend, we end up seeing nearly a 60% drop historically in what happens with pending transaction counts, because people are trying to get up to the mountains and go out and enjoy everything that Colorado has to offer. So you want to really keep those in mind as you're trying to be strategic about when to position your listing going into May. Going into May, you want to avoid those holiday weekends. Mother's Day weekend doesn't take as much of a dip. It takes a bigger dip at higher price points than it does at lower price points. You could probably list something up under 750,000 over Mother's Day weekend and still get multiple offers. But if you're going higher than that, people are taking that time off to be with family. Getting into Memorial Weekend, same thing happens. We end up seeing a big dip in our pending transaction activity. And so getting into that Memorial Day weekend, you want to try to avoid that. You also want to try to avoid price reductions as you're getting into those holiday weekends, because you won't have the same bandwidth of showing activity that next weekend to determine if you've made an appropriate price reduction or not. We end up seeing homes go for less over those holiday weekends than we do over other weekends, because those are the serious buyers that are out at that point in time. But again, we've watched a lot of nice activity coming in where our active inventory is growing nicely. And when I pulled that number for this week, it was up again this next week. So we're really starting to hit listing season at this point, but our buyer pool is starting to deteriorate. So it's going to shift what your pricing strategy is. When it comes to your pricing strategy, as you start listing, getting into these holiday weekends and into May, you really have to pull back on what your pricing strategy is, because we start to notice the price fall back as we go into June, July, August, and September. And so rather than pricing in the market, you might find yourself having to price slightly below the market, also to make up for that jump in interest rate, that impact to affordability. So you may have to price a little bit softer. And so calling those listing agents that just put properties under contract in your neighborhood where you're putting up a new listing to see how many offers and how many showings they got. Also using your showing time reports to see how many showings you should be getting will be a big benefit to you as you're trying to figure out how to price in this market. But I would say go soft on your pricing as we start to get into the second week in May. Getting into the second week in May, you want to probably pull back 2 to 3% in terms of what you would be pricing it for versus what you'd be pricing it for during the peak time, which was January, February, and the beginning of March for this year. The odds of selling ended up coming down to about 80.8%. And so that actually declined week over week. It was less than Easter weekend. It declined by another about 0.5%, but we're looking at about 80.8% odds of selling. The odds of selling is a ninja sales number. So for those of you that have taken ninja training, this is a number that you should recognize. But basically what it means is I take into account all of the available listings that are for sale versus those that go under contract and or close in the same week. And we're looking at 80% odds of selling. And so 20% are staying on the market longer than that 1 week. But that's down notably from where we were back here at Super Bowl weekend. Super Bowl weekend was an 87% odds of selling. It looks like this number is going to continue to deteriorate through the end of the year because we haven't seen that big pop of activity come back after we got past Super Bowl weekend, where that was really where everything kind of blew my trends out of the water. Usually Super Bowl weekend, we end up seeing the numbers go down ever so slightly, but it was the hottest weekend that we had in Metro Denver so far. So again, the odds of selling is going down. Historically, it's still very high. It's down about 4% from the same time that we were 1 year ago. And so the market is starting to cool a little bit as we've seen historically versus what we were last year. There's still no signs of a bubble that should be in our market. We only had about 6% of the inventory that we required to offset demand with 2,600 active listings in the market. To get to a point of balance based off of what went under contract last week, we'd need to have 43,000 active listings in our market. And so again, with only 6% of the inventory that we need to offset demand, that creates a cushion in our market between us going into a bubble. Now we're talking a lot about a possible recession on the horizon. Right. Going into the next couple of quarters. And a recession is not synonymous with a housing bubble. The housing market is what caused the recession between 2008 through 2012, whereas out of the last 8 recessions, in only one of them did we see home prices fall. So it's not likely that we're going to see home prices fall. And with interest, if home prices did fall, with interest rates going up, it still offsets. It would still be more expensive for you to wait to purchase a home. Even if we do go into a recession and we take a 10% hit on our average sales price, like what we did back in the Great Recession of 2010, which is again not likely to happen. If we lose 10%, that puts us at a $700,000 average sales price rather than the $780,000 sales price that we're seeing right now. So again, we have so much equity in our market that there's a big cushion there as well, where if a homeowner finds themselves in a level of distress and they're unable to make their monthly mortgage payments, they're able to list and sell their home very quickly to get out from underneath of it and walk away with all of that equity. We also don't have economic widespread hardship going on right now. The market is still booming. And so again, without that large widespread economic hardship that would cause a large jump in unemployment rates, we're just not likely to see some sort of recession that would impact the housing market at this point. Looking at number of shows per property was still down. It was only 9.7. And I've gone to a bunch of different sales meetings this week. And I've just asked anecdotally, tell me what your showing activity was like this last weekend. And they said it was a lot like Easter weekend, where we only had about 10 shows per property. So based off of this last weekend and listings from showing time, it was 9.7 shows per property. I'm starting to find some inlets to getting broker bay information located in here. And so with broker bay information, I'm going to try and couple that so that I can get all of the data for the total number of showings that are set. But again, the total number of showings that are set and shows per property is definitely down from where we were 1 year ago. As of right now, broker bay represents about 10% of all the showings that are set. So it's not a huge drop, but we did see the same similar drop as we went into April and May last year. And so that leads me to believe that we're still kind of tracking on pace with even just using showing time listings. But week over week, it was 9.7 shows per property. So this is strike one, where if you put a property onto the market and you think that you might have overpriced that property, if you didn't get 10 showings on that property, you might not be in the sweet spot in your market and you may need to consider a price reduction. Shows per property or shows to contract, we were looking at about 15.2 shows to receive a contract on a property. So people again are still looking at fewer homes before making a decision to make that purchase. They understand how hot the market is. And so rather than going out and trying to look at everything before making a decision, they're trying to get something under contract and they're acting a little bit more quickly. So this would be strike two. Strike one is if you didn't get 10 showings last week on a new listing, you might not be in the sweet spot. Strike two is if you've had 15 total showings and no offers, you might not be in the sweet spot in the market. We're still sitting at 4 median days on market. That number hasn't changed a whole lot at all since we hit the beginning of the year. 4 median days on market is likely to stay that way until about mid-June, where we'll start to see the market slow down right around 4th of July or Independence Independence Day weekend. I could set my watch to this market historically, where the second week or the third week in July, where people say, oh my gosh, I just did an open house and I had a lot less foot traffic, or I put up a new listing and I had a lot fewer showings. Is the market crashing? No, that's the seasonal retraction and the buyer fatigue that really sets in that second weekend in July. And so really to hit the sweet spot in the market, you need to be listed now through the beginning of May, because since our market hit off so hard and heavy at the beginning of the year, we could see our buyer fatigue setting in earlier this year than what we've seen in years past. So heed my warning. You want to get your listings to market now. People have asked if they know that prices are going to fall back as you go into June, July, and August. Should I wait until September, October, and November to list my home? You certainly can, because prices stabilize. They don't go up anymore as we go into the later part of the year, but they're not falling anymore as you go through those summer months anymore either. The rate of price reductions was 8.3% for the units that went under contract last week. So about 8.3% of all those homes that went under contract last week made some sort of price reduction. That's an increase week over week, that's an increase week over week by about 1.8%. We've steadily watched price increases going up since about Super Bowl weekend. They're still historically very low. Usually at this point in the year, we would end up seeing about 25% of homes reduce their price. We're only looking at about 8.3%. So the market was still considered very hot from that standpoint. The average price reduction was about 4.6% off of the original sales price. And it's been bouncing between 4 to 5% off of the original sales price for about 2 months now. And so again, between 4.5% to 5% is the price reduction that you would want to make. We're about $36,000 price reduction right now on an average priced home. So homes that are up to $500,000, we're not seeing some of those deep blue cells that are creeping in quite yet. So the under $500,000 market is really still very hot. We put more units under contract last week in this price range than we did in any other weekend so far in 2022. So pending transaction count is still very high. The active units that we would require to offset demand is very high. 4 median days on market is still ringing true as well. We're still sitting at only 0.2 months worth of inventory in the under $500,000 market. So that means that in 6 days, we're going to sell out of that existing inventory. Our average daily active count came up by 11.3% week over week. So we really saw the bulk of new homes coming into the market in that $500,000 to $1 million market. New listings in the under $500,000 market were up by about 20%. Pending transactions went up by about 13.5%. So again, what I'm looking at typically is how many new listings are coming into market versus how many are pending going into that market. And will we continue to see that month supply of inventory going up over the next week? And I think that it will go up next week based off of where we have been lately. We ended up seeing for back on markets that ended up declining by about 9.5%. So people aren't going back on market as much under $500,000 as we are at higher price points right now. The odds of selling is still 85%, which is down from where we were in Super Bowl weekend. Super Bowl weekend, that number jumped up to about 90% odds of selling. We're at 85.5% odds of selling. So again, this market remains to be incredibly hot. And as we continue to see affordability make an impact by way of higher interest rates, we'll see more downward pressure on people making a purchase under $500,000 rather than making that $750,000 average purchase price. Maybe they're pushing down to that $500,000 market so that they can keep their principal and interest payments more affordable. In this market, we only had 553 total active listings. We would need to have 14,000 to get to a point of balance. So we only have 3.9% of the inventory required to offset demand. So this market, again, very well insulated from any sort of bubble event that could be happening in our marketplace. Shows per property, if you put up a new listing that was under $500,000, we're looking at about 16.5 shows per property, looking at 16.7 shows to receive a contract. And so again, that's strike one. Strike one being if you had a new listing that you put up last weekend and you didn't have 16 showings, you might not be in your sweet spot. And again, 16 showings should have yielded you an offer. So you should be under contract in that first weekend if you have a listing that's under $500,000. 4 median days on market, not changing at all, probably won't start changing until we get into about July 4th weekend as we start to get back to school into August, but it's 4 median days on market. 6.4% of homes reduced their price in that's under $500,000 market with an average price reduction of about 5.1% or about $21,000 was an average price reduction in that market. 500 to $1 million, this is really where we have the bulk of our properties right now. And you can start to see that cooling trend where we're starting to get a lot more new average daily active count, new listings coming back on market and back on markets in this particular price range. We're also looking at a shift in the days that we get until equilibrium at this point, and shows per property is starting to turn down. So we're starting to hit the cooling trend right now in this market. So again, our pullback could happen earlier this year than what we've seen in years past. Average daily active count week over week went up by 26.4%, and it's up from 1 year ago by 138%. And so again, a lot more active listings this year than where we were 1 year ago. New listing count came up by 49.7% week over week. And there's such a significant jump because there were fewer new listings that made their way to market as we went into Easter weekend. But then again, as we started to go into as we come out of Easter weekend, watching the market rebound a little bit, pending transaction count went up by 43.3%. So our month supply of inventory is likely to go down next week because we didn't put as many new listings on the market as we put under contract. And so again, we're likely to see that market will tighten back up as we get into the next couple of weekends here. Back on markets, we're up by 31%. So again, could that be buyer fatigue? Could it be buyer remorse for purchasing a property between 500 to $1 million right now? Odds of selling was 81.1%, which is down from where we were over Super Bowl weekend. It declined another 0.5% from where we were last week. So this market is really starting to taper off as we get deeper into the spring and into the summer months, going deeper into 2022. We still only had 6.2% of the inventory that we required to offset demand. With about 1,500 active units in this market, we should be closer to 24,000, 25,000 to get to a point of balance in this market. This is really where the sweet spot is in the market, is this 500 to $1 million price point. Any new listing that came on market this week, you should have had 9 total showings on that particular property, with 14.3 showings should have yielded you an offer on that property. So if you didn't have 9 showings, or if you've had a total of 14 showings and no offers, it might be time for a price reduction. We came back down week over week, whereas the last week, Easter weekend, we were looking at 5 median days on market. We're back down to 4 median days on market. So people really took a minute to take a breath over Easter weekend. So again, being careful of those 3-day and religious-based holiday weekends as you start to list your properties. Price reductions went up. So we ended up seeing that 9.3% of those homes reduced their price going over last weekend. And so 87.4% didn't have to make a price reduction at all. Average price reduction in this price range was about $34,000 or about 4.3%. 1 to 1.5 million. So again, this market is heating up. This market tends to hit later as we get into the over $1 million market than we do for the under $1 million market. And so we're starting to see some heating up. We're not seeing quite the cool down yet in this $1 to $1.5 million market. It tends to hit later in the second part of March, April, and the beginning of May is really the sweet spot for this particular target market. In this market, we're looking at about 0.5 of a month of inventory. So in about 15 days, we'll sell out of the existing inventory. Average daily active count came up by 27.5%. Pending transactions were up 74% over last weekend. So that really speaks to how much of a decline that we see over Easter weekend in terms of showings and pending transaction count, especially as we get into higher price point properties. So again, pending transaction count was 127. That was up from where we were 1 year ago by 101.6%. Back on markets, there were only 7 that came back on market, and that was down from the previous week by about 5%. So these properties are sticking a little bit more as you get into that $1 to $1.5 million mark where people are staying on the market. Odds of selling was 76.6%, which is still not that far from where we were back in Super Bowl weekend, where we hit about 81%. It's only declined by about 5% overall from where we were Super Bowl weekend, and it's remained incredibly high for the last 4 to 8 weeks. And so again, this is really the sweet spot in the market for those $1 to $1.5 million homes, where you want to have those homes listed and on the market by that second week in May. In this market, we only had 264 active units. We would need to have closer to 5,000 to get to a point of balance. So we only had 5.3% of the inventory that we required to offset demand in this particular market. Looking at 5.8 shows per property. So that came up from Easter weekend. Again, Easter weekend, you should have only had about 4 showings. Now you should have 6 showings, which is still down from where we were over Super Bowl weekend, where we were looking at 12 to 13 shows per property back in January and February. So again, more inventory in the market. Buyer fatigue equates to fewer shows per property as we're looking at going into our spring months. 12 shows to contract. So if you've had a total of 12 showings and no contracts, you might need to make an adjustment in your price. We dropped back down to 4 median days on market. It was 5 as we went into Easter weekend. So again, an extra day to look at those homes as you were looking at Easter weekend.
So that's like Tuesday.
Yeah. So instead of going under contract on Monday, they went under contract on Tuesday.
Yes.
Usually what I end up seeing is for Easter weekend, if they're adamant on listing over Easter weekend or a 3-day holiday weekend, they'll activate the listing on Wednesday and start showings on Thursday and Friday. So it gives us an extra day for people to look at homes since they know that they're not likely to be looking at homes on that Sunday. For the $1 to $1.5 million mark, we were looking at about 8.8% of those homes last week made a price reduction to go under contract with an average price reduction of about 4.5%. This number bangs around all over the place based off of your weekends. But what's interesting to see is that if you're listing and going under contract in the last week of the month, that you tend to have larger price reductions. And so it's interesting to see that trend kind of reveal itself. Last price segment that we'll talk about is the $1 to $1.5 million mark. Again, what you can see is that market is really heating up. And so this is where the market really becomes hot for the $1.5 to $2 million mark. This market hits a little bit later than what we see for lower priced homes. We're seeing a lot more pending transaction count, closed count is up, and what we need to offset demand. So our average daily active count has also remained very strong. But again, we're looking at a lot of red cells over here for our odds of selling. And so again, the time to list, the best weekend to list was either Super Bowl weekend back here in February or Easter weekend, if you believe it or not, was a really hot weekend for that as well, which is interesting to see that number pop up that way. Average daily active count came up. We had 106 active listings in this market, or it came up by about 26.2%. Pending transaction count went up by 62.5%. So our month supply of inventory is going to go down as we go into next week because there were a lot more pending transactions that went under contract. Month supply of inventory, we're sitting at 0.6 months worth of inventory. So that means that in about 16 to 17 days, we're going to sell out of the existing inventory in this particular market. Back on markets, there were only 5 of them. And so that was week over week. There was no change in that number. So we're looking at about 5 of these properties each week coming back on market. New listings, there were 51 new listings that made their way to market. And that was an increase week over week by 88.9%. So a lot of people avoided listing over Easter weekend, which is what equates to this big giant jump in new listing active inventory. Odds of selling was up to 72.5% week over week. That was down by about 2.3%. So again, we're still seeing a very high odds of selling in this particular market, still as high as it was as we came into the market. Back at the beginning of the year, we've been bouncing between 72 to 75% odds of selling, a little bit less on some of those holiday weekends as we're going through. We only have 5.2% of the inventory required to offset demand with 106 average daily active count. Active units for balance, we should have closer to 2,000 active units in our market. So again, we only have 5.2% of the inventory that we require to offset demand. This weekend, we saw a jump in the number of shows per property. You should have had 5.5 showings for a property that you listed during this last week, 14.6 shows per property to go under contract. So if you've had a total of 14, 15 showings and no offers, you may need to reduce your price. We dropped down to, or we stayed at 5 median days on market. We've been bouncing between 4 and 6 median days on market since the beginning of the year. So it's likely to stay there probably up until we get July, where the market starts to cool back. We're seeing more price reductions coming through in this particular market. It was 10.8% of the homes had to reduce their price, 7.4% price reduction, or $156,000 was an average price reduction in this particular market. Now, again, as we go into higher price points, this is actually the sheet for pre-COVID for the $2 to $3 million price point. As we see, March is typically the hottest time frame for this particular market. It's going to hit a little bit later this year as it is at other price ranges. So over $3 million, usually what we're looking at is that May time frame is really where you want to be in the market for that higher price point. And so actually, I forgot to do one thing, escape this. There, now it won't screw up yours. So
lovely.
Again, the market remains hot overall. We ended up seeing that there was a big jump in activity coming off of Easter weekend. So good news there to see that new inventory making its way to market. Inventory is going to continue to rise until we hit about September at this point. So more inventory making its way to market overall as we go into the later part of the year. So again, happy hunting out there. Things should be loosening up and you shouldn't be as in quite extreme multiple offer territory, but things are still going for over asking price, certainly. No questions, quiet group today.
I'm telling you. So you guys absolutely ask any questions in the chat, comments here. I've been watching it on the live. There's no questions there. So we're going to go jump into what's happening in the economic side of things. The Fed is meeting next week. The expected 50 BIP increase is on the table. Powell has come out saying it himself. So it be said, so it be done. So we're thinking that that's going to happen. Then it's a big question mark on whether or not we're going to see 75 bips at the Fed meetings after next week's. So will we see 75 bips over the next several months? And really the question is going to start looking at, should I do a HELOC? Should I do a cash out refinance? How do I take out equity? I am having conversations multiple times every single day where people want to take advantage of all the equity that they've built up, but how do I do it? Because just 4 months ago, the interest rates were 2 points less. But so a HELOC looks better, but I know 4 months from now, the HELOC is going to look a lot worse. So being very diligent and purposeful in your actions that you take right now will kind of create the success that you want. So we're going to just talk about what else is happening in the economy, how strong is the market, the conversation still around the bubble. And I want to just kind of give you some of those tools to support you with. Yep, I haven't shared yet. Oh, you want to share?
No, I was just looking at the chat.
Oh, here we go. No, anything there? And we do have a question that just popped up. So let's just make sure before I start sharing. On the average in Denver, what percentage do you see offers going over list?
Oh, for the $700 to $1 million mark. So based on closings that happened back in March, it ended up being, it was 3 out of every 4 were going for over asking price. And the average over asking price was about 9%, but that was for closings back in March. So it was probably under contract back in February. And so that number has probably come down from there.
Yeah. And a question about the cash buyers. I know cash buyers are going up nationwide. I just read that it was over 30% cash nationwide, but I don't have the number for local.
So locally it was 20% were cash transactions.
Okay.
The last time I looked about 2 weeks ago, and it was about 20% of them were cash transactions.
Yeah. Mm-hmm. All right. So let's just jump into this. So I'm going to start sharing my screen. All righty. So let's just jump into this conversation around the bubble. And I want to make sure that we're sharing the screens. There we go. All right. So let's just start talking about the bubble just a little bit. So this article, and I've got some articles that just came out this week. This one is from a month ago. So you've already seen it. We've already even talked about it, where the Fed came out and they said that we're finding signs of a housing bubble. And of course, there was a lot of articles that happened right after that. And then there were continuous articles beyond that. And this still continues to be a hot Google search item. So as we jump into this, as we start seeing home prices slow down, as conversation to go, okay, is this going to be the beginning? Because if you listen to what Megan is saying, and we expect home prices maybe even to inch down a little bit to stay relatively flat. Now, I'm going to tell you that if we do go into a recession, which will probably be next year, based on my guess, we're going to see interest rates go down. So I'm thinking, well, shoot, should I just wait until next year to buy? If you're saying we're going to see home prices slow down, and I'm saying you're going to see interest rates come back down, I'm thinking I'm going to sign another year lease. That conversation is happening 100%. So we have to step in and talk about the fact that appreciation slowing down does not mean depreciation. That home is still going to cost you more. And locking in that home price today and being able to refinance it next year gives you the best financial solution, not waiting, right?
Yep.
So as we jumped into this, I just started kind of thinking, what can I give you that you could take and show your clients, right? So what kind of visuals could we create? Because I wanted to pull out a couple of statements that they said specifically. They said that their evidence, turns towards an abnormal housing market behavior, right? Like this fear of FOMO, that clients are getting in there, jumping in there, buying above their means because they were looking at price to rent ratio and the price to income ratio. Totally fair. But then they went on in that same article saying, but based on present evidence, right? So based on present evidence, there's no expectation that the fallout from a housing correction would be comparable to 2007, nothing near the financial crisis. And this had to do because of the household balance sheets, all of them in better shape. This has to do because we have stronger credit buyers. This has to do with the fact that we have more equity and more stability. So that's where my head started to go. So I just started to show some of these screens so that you could take these, use them on social media, use them in your conversations. So the household debt to income is now at a four-decade low. So if I take this off of Fred, which is a phenomenal, it's a government database, absorbs all the data, puts it out into graph format. You can change it where it shows you year over year, month over month. You can actually show it as percentages or units. So really interesting tool to access Fred if you've never accessed it before. Tons of data on here. So one of the things that they show is this household debt to income. And it is, although it feels higher, of course it does. It's going to feel higher than what we've just experienced because we all had a lot of money and interest rates were abnormally low. But if we go back 4 decades, it's still historically low. So is mortgage debt, again, higher than it had been, but less than it's been over the last 4 decades. So as I look at this, it's about perspective. I was having a conversation with Jeremy King yesterday, and they just sold a home and bought a home, clients of his. And the clients of his, they had bought that home that they just sold pre-pandemic. And interestingly enough, they have almost the exact same interest rate, right? I mean, it's perspective. So yes, compared to the candy that we just ate, right? It doesn't taste quite as good, but it does if you compare it to 2019. So mortgage debt is low, total household debt is low. Then household equity is at a historic high. So when we look at this, we see that we now have a 31% loan to value because of this massive growth in equity. So across the nation, we're looking at, on average, we have 11 trillion in mortgage debt, 26 trillion in owner equity. So we have 38 trillion in total real estate value. So that kind of massive spread, when you were just talking about this, even if we lost 10%, it's coming off that high. Now, somebody that literally just bought, and they bought at 100% loan to value because they did a USDA loan, a VA loan, a down payment assistance loan. Are they hurting? A little bit, right? They are hurting a little bit. But if you hold on to that, knowing that home values always go up, then all you have to do is hold on and not sell. But everybody else that bought anywhere before the last, say, month is going to have enough equity that they've built up. I have people reaching out to me that literally bought, especially if they bought new builds, literally bought at the end of last year looking to say, can I tap into some of this equity that I've got? I'm like, wow, it is, especially new builds, right? Because they sat on it for a year. So yeah, they have the kind of equity that we can do those refinances, cash out. So that's a huge plus. Another plus is the actual loan profile of our buyers today. When you look at what we actually have in credit scores. So most of the borrowers now, because of the crunch that we experienced in 2020 and 2021, and the fact that we have such a competitive market, a lot of people with down payment assistance and FHA and VA across the country are not getting under contract. So you have a lot of these buyers at the higher loan to values and higher percent down. So our buyer pool is just more adapt to sustain any change in the marketplace. They'll just be fine, right? Even if we do see some of those values go down. That we also see not only a low number of foreclosures, which I'm going to show you some local numbers here in a second. And we know this because we saw there was a moratorium on foreclosures. And now when it is coming back online, everybody's got so much equity, they're just selling. But we don't even have bankruptcies like we've had before. So people just aren't in a position. We have 11 million open jobs. Pre-pandemic, we had 7. So we have more open jobs. We have record low unemployment, right? And we are actually seeing a drop in the unemployment claims. The new unemployment claims this past week just dropped 180 people. So we're continuing to see the people that want to work are working. The people that don't want to work certainly have enough money. They're not running into bankruptcy issues. They're not running into foreclosure issues. So we just have a strong credit profile of our buyers. Black Knight put out a report for the national delinquency rate, and we actually hit a record low nationwide. So mortgage delinquencies, when you're going past 30 days late, dropped down to 2.84% in March. Remember, they're always about a month behind because it's this national data. So that drop usually is about a 10% drop from February to March. It dropped 15%, just continuing to show how strong our housing market is going into whatever this economic change is going to look like. Because will we have an economic change? Yes, right? We will hit a recession. We will see 2 consecutive quarters of GDP decline. I'm going to show you that in a minute. I don't think this quarter counts, but we're going to get into that, right? So we're going to see this. We're going to see it shake up a little bit with the Fed raising the Fed rate, because that is going to impact the ability for businesses to reinvest, for people to reinvest, and people to spend, which goes into the GDP. But right now, the delinquency is down because people's ability to maintain and make their mortgage payment is high. Colorado made the bottom 5 list. Again, we continue to stay there. We're constantly hovering within that bottom 5. We have a 1.8% delinquency rate, which is fantastic. So here in Colorado, especially strong. So as you're working with any kind of buyers who are thinking that we might see any kind of reduction in home prices to the extent that they're going to find something on sale, then you can show them some of these graphs to know, especially here. Now, we all know that real estate is hyperlocal, and we all know that some areas, right, are
hot pocket.
Hot,
the hot pocket.
It is hot. We know that some areas are not going to fare as well. Some areas are going to pull back from the extremes that they've seen, or some areas just aren't going to recover if we do hit to a recession. But we can consistently say that Colorado, especially the Denver market, will continue to sustain its housing strength. So Colorado's delinquency is super strong, plus the fact that we're in the top 10. So of all of the originations done nationwide, the Denver market continues to draw people. I know that there was an article a couple of weeks ago about people migrating away from Denver, but then you just had to look at Douglas County, and that's where they all landed, right? It wasn't that they were leaving Colorado, they were just leaving downtown. So as people move around the state or move around the country, Denver continues to see our fair share. We're at number 10 for our volume of originations. Now, this does not include cash buyers. This just includes those buyers who are coming in and they're using a loan. But when you look at that, we have an average credit score of 741 as of last month, and this changes every month, of course, with an average loan to value of 73%. So folks are putting down almost 30%, right? So they're putting down 27%, and they're looking very strong, especially here in Colorado. Mortgage purchase applications were down 17% year over year. Not a huge surprise. Interest rates are up 2%. So it's not surprising to me at all. But when I look at this and I look at the long-term growth, we are still in an upward trend. Are we down from last year? Yes, because interest rates were so good, but overall that demand is more heavily reliant on the demographics and those first-time home buyers and all those millennials and those Generation Z right behind them. We will continue to see mortgage purchase applications move relative to 2020, 2021. But as we look at it compared to 2019, we're still strong. Demand still exists. People still buy homes at 5%. I'm just saying that out loud. People still buy homes at 6%, and people will still buy homes at 7%. Did they and will they miss the 2.625 or the 3% interest rates? Yes. But historically, interest rates are not that far off. So we're seeing interest rates above 5%. Freddie Mac is there, and all of the surveys are above 5% right now. And this is for a primary home, 20% down. So if you're doing an investment or second home, it's going to be even higher than that. But if we look at this, so everybody's talking about the fact that, well, we haven't seen interest rates this high in 11 years. Well, that's because Freddie Mac, which includes discount points, didn't hit 5% in 2008, yet the market hit 5% in 2008. So if we look at that, we see that the market hit 5%, which we also felt going into 2019, where we saw the appreciation was low, right? I mean, the appreciation was it was below 3%. So we saw the impact of that, but yet homes still sold. Inventory was about 1,000 less, and appreciation was still positive. So none of that, those increasing interest rates affected the housing market in a devastating manner. Did it affect the housing market? Of course, but we've been bouncing between 4 and 5%. I'll say 3.75 and 5% for years, really since 2010. And before that, it was always higher. So to say that we're at 5% now, historically, I just wanted to make sure that we were there just a couple of years ago. CoreLogic also puts out a report every month talking about the appreciation. This is old. I don't love showing CoreLogic, but I do like it because it gives us a track record historically of showing where's the actual factual appreciation. So that home that changes hands every time is recorded in these massive databases. We do a fantastic job. Megan does a fantastic job of recording the median and the average year over year and month over month. But this is looking at each one of those homes and how much those areas, those zip codes, those metros are changing. So as we see this, the whole country actually started to take a dip and then came right back up again and revved up. We actually saw February was a little bit less than March. March, we saw it rev right back up again. We're starting to see a little bit more inventory that will continue to shift, but home prices nationwide went up. Here in the Denver market over the last year, we saw 22.3%. So that's higher. This is February again, but that's higher than CoreLogic stated January's was at 21.5. So they actually saw us pick up, whereas our median, our average was a little bit less going into March. March picked right back up again. So 22.3%, super, super strong for anybody that bought, jumped in, thought they were in over their head, got in. I don't want to say in over their head because you don't want anybody to buy in over their head, but you want them to buy maybe just outside their comfort zone because that budget locked in isn't buying them as much home. But as long as it still meets their debt to income ratio, their income, those things, they have to be willing to expand their boundaries a little bit. So 22.3% since the beginning of the pandemic, cumulative, the Denver market has increased 35%. You talk about a win for anybody who bought a home, bought a second home, bought an investment property, anybody that took the plunge and actually moved money with everything that's going on with the Fed right now, with everything that's going on with inflation. We're seeing the stock market is having some fuss. I'm not going into the stock market. I'm not an expert in the stock market, but I have money in the stock market and it hurts my heart right now. But I'll just say that everything that we're seeing going on in the stock market, I am having daily conversations about people deciding to pull some of that out, depending on where they have their money and putting it into the consistency and the longevity of real estate, something that is going to hedge against inflation and give them the long-term returns, offsetting some of the drops that we're going to see in the stock market if the Feds continue to raise the Fed rate and if we do push into a recession. So as we see this, having those conversations to say, look, I'm not a financial advisor. I don't want to talk about necessarily the returns that your stock market is seeing, but do you have access to other funds that maybe at this time you want to start diversifying? And is real estate where you want to do that? Because based on the returns, the last 2 years, we saw 35% cumulative return. Now, if we go beyond that, we consistently see the Denver market and all real estate continues to go up and provide that offset and the power of leverage. That is really the win with real estate. So FHFA also comes out with a report separate from CoreLogic that simply shows the lower price points. So these are the loans that are in the conforming loan limits. You could buy a $2 million home and still have a $500,000 loan. You're going to be in this bucket. So it's not necessarily about your home value, but it's about your loan amount. That was actually up slightly higher, right, than the national CoreLogic number, which you would imagine that those homes in those lower price points are going higher, hotter. We're seeing that. In fact, there was an article that just came out that said that Denver average home price could hit $1 million by Memorial Day. We're seeing this accentuated value, right? And of course, if we see the average is over $1 million, it's because there's not so much going on down at the bottom that those higher price points are pulling that average up. So there's actually two articles that went right with this storyline. This is the first one. And I got an email saying, can you actually quantify this? Because this seems really high, really fast to me by Memorial Day. So I actually ran the numbers. So based on the DMAR numbers, and your numbers with the 8 counties would be really close, right? But so based on the 11 counties, the 797, if I increased it 8%, which it did in March, month over month, that's a month over month number, not a year over year.
Month over month.
I checked it twice. Like I was like, okay, that's 8%.
What? Okay.
Yeah.
Okay.
So we continued at the speed, which we're not feeling like we're going to, because it's just going to start, it's not going to go backwards. It's just going to start to soften as we get more inventory online. I've had 3 different conversations in the last 48 hours about buyers being the only offer over asking. So the buyers are going to start figuring out that there are not as many offers going in and they don't have to go over a list in order to get that home anymore. So that some of that is going to calm down. So even if we kept up with the 8% though, March, April, May, June, it's going to take till June. So it's going to be just a hair after Memorial Day, not by Memorial Day, but I'll give you that. If I actually drop it down to 5%, because we're going into the summer, because we're getting a little bit more inventory month over month, it's going to take till August. Could we get there before the end of the year? I think we're going to get there before the end. What do you think?
I don't think we're going to get there before the end of the year.
You don't think
I'm
they'll
not
slow
taking
down?
into account the pullback that we start to see in our average prices for June, July, and August. I just don't know that we're going to see those numbers.
That's a lot. We typically
insane.
see like 1.5% growth month over month, not 8, and certainly not even 5.
Yeah. And so it's just, I think that we had a really crazy first couple of months.
Yeah.
I don't think that we're going to come anywhere near that. I mean, I think that we're going to go over 800,000 this month. But I think that maybe we'll tap out 850 maybe before we start to see prices fall back again.
See, my gut was telling me 9, but it was not telling me 1 million.
Yeah.
So
I don't think it's going to be.
I should have done one more and actually shown 1.5%, which is really where we'll probably end up being.
Yeah.
So then the other article that I grabbed that I thought was funny, I don't know, it's depressing actually. The Denver homes under 300,000 have become extinct. So, when I think about that, it is like, if you're in the 300 price point, you're looking at a condo or a townhome, a single family home is just going to the fact that because they aren't there, because our home prices are going up, because now that 300,000 that you could get 2 years ago isn't 300,000, it's 30% more than that. Right. And then of course the averages, those bigger price points and those jumbos are pulling up the entire market. So as that's happening, so I just, as I was thinking about the kind of inventory, and you talk about this all the time, like you need 14,000 units at this price point between these two price ranges to get from here to there. So to have seen how much we've dropped down here in the Denver 11 county area, to say that in 2008, we had 25,000 and today we have 2 nationwide, we had 4 million and now we have less than 1 million. And if you actually discount all of those new builds that you can't even purchase yet, or those pendings, that number is a third of that. So that kind of inventory extreme, it's going to take a long time to get out of this and we can't build our way out. So the fact that you can't find a single family home under 300,000, but I don't think that we'll necessarily hit 1 million by Memorial Day. So another news points really quickly, GDP, it did contract. It went down 1.4% annualized. I don't think that this is the first of the 2 quarters consecutively that we're going to see that drops into a recession. I think that this is because of shipping containers. I think, and I had to throw that in.
We haven't done shipping containers for a while.
So this is, they stole them all. Look at that. Shanghai has all of our shipping containers.
Look at that.
They took all of them. This massive map shows you all of the boats sitting, waiting to be unloaded, and nobody can in Shanghai because they're all under house arrest. So given the fact that due to COVID spiking up, they're all still in their homes, these shipping containers are stacking up, the boats are stacking up. This is what's causing the GDP to go down, because interestingly, spending was still up. Now, it wasn't up as much, it was up 1.1%, but that's a really good number. So spending was up 1.1%. What people are doing is they're not spending on goods as much, and there's now spending on services. They're going back out to eat. They're going to Disneyland. They're going on flights. We're seeing that because the airlines are having all kinds of problems trying to get enough pilots to fly all the flights that people are demanding. So personal consumption is up. Personal income is up 0.5%. It's less than inflation, which was up month over month 0.9%, but it's still up. Wages are up. PCE is up. I'll show you wages in a second. So inflation was up 6.6%. That came out this morning. This is the PCE number. This is not the consumer price index, which was up 8.5%. This is the Fed's measure of inflation, and what will go into the conversations next week and what will go into the conversations over the next couple of months. But this is up. We're feeling it. The cost of everything is up and what they're trying to stamp down. But in the meantime, wages are up, and Denver hit the top of the bucket again. So hourly earnings, it does not equate to weekly earnings. Weekly earnings were more like the top third of the pack, because people in Denver work less when you make more money per hour. They go skiing and hiking and biking.
We do Colorado stuff.
We
We do
do.
market updates from tin cans.
We do market updates from tin cans. That's going to be my next tagline. I do market updates from tin cans. So, but hourly, we're making more and our numbers are going up more than the rest of the country. Weekly, we're not quite as high, which I thought was hilarious. That's the paychecks numbers. But everything is going up. So when we look at this, we've got strong households. We added over 2 trillion in equity last year. We've got jobs. When I look at this, this is a median home price. We've got hires going up, non-managerial wages going up, consumer spending going up. This is overall a strong market. But interestingly enough, consumer confidence is still down because they're having to deal with this. I feel stressed. Everything costs me more. I don't know if I should be in this market anymore. But I know the long-term benefits of real estate. I feel good. I'm still making money. Should I feel okay to spend the money that I'm making or should I hoard it? What do I want to do? I want to go out to Disneyland, but should I? So there is so much of this conflict going on right now, this tug of war. We have to continue to sharpen our saw and continue to have those conversations and be open, put ourselves in front of the conversations. And I wanted to remind you, I had so much fun over the last week putting all of those new products, and that the PowerPoint from last week is still up on our Agent Ignite Facebook group page where we just did the whole 30 minutes on all the products. I'm not going to read all of this, but just remember if there is a will, there is a way. If that buyer can get in through credit repair, through planning, through saving up, through having a conversation with the lender, setting up a plan so they know exactly what to do to get there or what products are available to help them get there, then we want to do that. If there's anyone that I can help get into home ownership, you know that Megan, nobody works harder than Megan and I in making sure that that happens. So creating that A team where we're all sharpening our saws together to support this tug of war that's going on, because emotionally they're stressed, but financially their homes and their wallets are actually doing really well, especially at the higher price points. So we continue to have this. We have the cash guarantee, which is phenomenal. Of course, we personally, we're doing a lot of bridge loans, helping people purchase before they sell. And it's coming this weekend. This weekend, we start the planning for the next big thing, 2023. We'll start dripping announcements on our keynote speakers, on all the other speakers, on our location. But save the dates. February 2nd and 3rd are the dates that we're shooting for. We're nailing down the hotel this week as well. But just really excited to share that information. All right. That is all I've got. Let me get out of here.
Got a ton of questions.
Yeah. All right.
Let's see. Great question, Savannah. Where's Savannah's question? Let's get back up here. We missed a bunch.
Did we?
We missed a bunch. I'm seeing a slowdown in showdowns and offers and believe it has to do with the raise in interest rates. And I'm wondering how the 50 bips on 5.4 will affect the market even more.
So the 50 bips have been baked in, right? So unless he does something different, unless he does 25 or 75, the 50 bips are pretty much baked in. At this point, the inflation numbers came out exactly as we expected, those to continue to go up, the PCE this week for them to make the decision to do the 50 bips. I would be shocked if they do anything but. What is going to change the market is really, are they going to do the 75 bips the following month? And how does the market start anticipating that based on Powell's comments next week? So that's what we'll be watching for.
So, hey, Nicole, will we start to see assumable loan transactions? If not, why not?
So everybody's talking about assumable loans and ARMs. Those are the big conversations, right? So assumable loans, you have to go back to the servicer. So whoever, you can't use like a typical lender, you have to go back to the servicer who's holding the loan. And the issue is it's that loan. So you've got a ton of equity over the last 2 years that home might sell for 600,000, but the loan was kind of like left in the dust. The loan is only 400,000 or 350. And so that assumable loan at that low interest rate, now I have to have a buyer that has the difference in cash. The last time assumable loans were a hot thing, we just didn't have this kind of appreciation. So it was much closer. So if you had to bring in the difference in cash, you could kind of get there through gifts or maybe a second loan. Now it's different. So if you're going to do assumable loan, you're going to have a lot of cash in your pocket as well.
So Nicole, for buyers that started shopping at lower interest rates and now aren't getting as much, is an ARM worth it?
ARMs are a tricky subject, and you better talk to a lender that has the buyer's best interests at heart, because I can sell an ARM just like I could have sold an option ARM, and I wouldn't have done it then, and I won't do it today. But if I know I have a buyer that for whatever reason is absolutely not going to keep that home, their life is changing, they're going to have a baby, they're going to get a job transfer, they're going to graduate from doctorate school, whatever that is, if I know that they're going to be moving up and not keeping that home, then I would say an ARM makes a lot of sense. You can get an ARM, maybe a primary home interest rate today is 5.25. I'm kind of making this up because, what credit score, what are you buying, how much you're putting down, the whole thing. So an ARM might be 4.25 or 4.5. You could get a point in savings on an ARM, but is it worth the risk? When that ARM expires, will rates be higher? Mm-hmm. So you just have to protect yourself against that.
Yep. So Jeff is asking, what is the best way for a homeowner to access equity at the cheapest rate without having to sell the home?
Well, a HELOC is going to be the cheapest way if that's your question, but it's also your riskiest way, because the HELOC rates will go up with the Fed rate going up, the Fed rate, the bank rate, then the HELOC rates. So your best way is to lock in with a cash out refinance today, even though the interest rate is higher, and then doing a rate and term refinance in a year if the rates do come down again, and there'll be movement. You're not going to have interest rates go down to 2.5 and stay there for forever. So grab it when they come, do a rate and term refinance, but pull it out with a 30-year fixed. Mm-hmm.
How often do we do these Zoom meetings? Are super helpful. So we're doing these on a weekly basis at this point. We're going to have kind of a funky schedule going into May with all of the events that we have going on, and then into June and July. Keep in mind that in June and July, we're going to be switching to Thursdays at 10 o'clock. In May, we're going to keep it on Fridays at 10 o'clock. There's going to be some times where Nicole can make it and I can't make it and she can. And so we're going to be switching around a bunch, but we're going to still continue to do it every Friday going into May of 2022. So keep that on your schedule, block off this time. We do send out a copy of the recording and the slide decks. Nicole posts her slide decks into her Agent Ignite Facebook page. I post mine. I actually email mine out each day. My CRM is running really slow. I don't know what's going on, but I'm going to hop off my computer right after this. I'm going to pull the roster of everyone that attended, and I'm going to get you a copy of the slide deck and everything, but it might take until tomorrow for everyone to get a copy of everything.
It's running that slow.
It's running that slow because I have 5,000, 6,000 people in my distribution. So it takes a little bit of time for it to kick out. Whereas normally it would take about 2 hours for me to kick through everything. So it's taking a little bit longer to get all of that out, but you'll get a copy of everything. I think that's everything.
I think so.
So with that said, I think we'll go ahead and sign off for now. So thank you so much for joining us today. We always appreciate you joining us on Friday mornings at 10 o'clock. We'll continue to do that through the month of May. Again, it may be one of us, both of us, but we'll be still having that 10 o'clock weekly update for you. You'll get a copy of the slide decks, hopefully this afternoon, but if anything changes, I'll be sure to let you know. Thank you so much for joining us today, and we hope that we'll continue to see you. I'll send out the dates for May next Wednesday, so you guys can register for those events coming up. As always, the reason why we put this information together for you is we want to help you better advise your buyers and sellers. And we certainly hope that if we're able to help you better advise your buyers and sellers, that we'll have an opportunity to meet them at our closing tables, be it with Fairway Mortgage or with First American Title. So please feel free to keep us in mind going forward. And with that said, we hope you guys have a great weekend.
Absolutely. We'll talk to you soon. Bye-bye.
Bye.